Welcome to the Jay Martin Show. If you're new to the show, my name is Jay. I'm an investor. I'm here looking for the smartest home for my cash. If that sounds like you, then I think you're going to like what we do here. My guest today is Michael Pento of Pento Portfolio Strategies and some deep forecasts today. I asked him what we're going to do about the $2 trillion deficit, and his response was it's going to become $6 trillion before we're done. So a little teaser of what we get into today. You're going to like this one. Quick announcement before we jump in. On November 30th, I am hosting a live online private event called Crisis and Chaos, the Changing World Order. And my guest roster is absolutely mind-blowing. I'm going to be joined by a handful of U.S. presidential advisors, former leaders within the Secretary of Defense, Navy SEAL veterans, terrorism experts, mercenary army leaders, and a former Supreme Commander of NATO to discuss the shifting geopolitical order. This is without question the biggest event I've ever been a part of. Check out crisisandchaosevent.com. There's a link beneath this piece of content. I'd love to see you there. But here is Michael Pento. Enjoy.
This is Jay Martin.
All right, here I am with Michael Pento. Michael, welcome back to the show. It's great to chat with you.
Always good to be on with you, Jay.
Okay, let's start here. I had a chat with a buddy yesterday who recently de-risked his portfolio. He went to cash like maybe a month ago, was paying attention to a lot of macro, didn't like what he was hearing, didn't like what he was seeing, decided it was time to get out of the market. I spoke to him yesterday. Most of his positions are up 30% since then. He feels like he's made a massive mistake. So how would you counsel this individual right now in this scenario?
What the heck is up 30% in a month? I don't know what's up 30% in a month, but I'd love to know if you could tell me. But I kind of empathize with him getting out of the market to a great extent. I think he should have gotten out in late 2021 because that's when the bear market peaked. With all the hysteria of the AI craze, and you could throw in maybe the end of the Fed rate hikes, because when the Fed stops hiking rates, don't you know the market just goes to the moon? There's no more problems when the Fed stops hiking rates. I mean, historically, that's complete. I don't curse. I try not to. But BS. Okay. It is horse hockey. Okay. The last rate hike, heading into the Great Recession, the Great Global Meltdown, when stocks dropped by over 50%, the last rate hike was in 2006. And the first rate reduction was September of 2007. Now, Jay, was September of 2007 a really great time to buy stocks and to go, take the green light that the market and the economy is going to boom? Absolutely not. So the Fed has, in my opinion, stopped hiking interest rates, perhaps at 5.25% to 5.5%. But let's not forget that they were at, in a real sense, a negative 8% real Fed funds rate in 2022. We're now at a positive 2% plus as we record this interview. So, excuse me. So a lot of damage has been done. And as these debts refinance and roll over, you're going to see a lot of carnage to the economy and to the stock market. Just be a little patient. But I just wanted to wrap up that question with a bow. The S&P 500 is down 6% despite all of the BS you hear about the Fed being done. It's down 6% from the cycle peak. I do business cycle measurements, and that's how I manage money. I look at the second derivative of inflation and growth, and that informs me where to invest along a 5-sector spectrum between deflation and hyperinflation. If I know where we're headed, and we know where we are and where we're heading, I'll know best where to invest your money. And you are down 6% in the S&P 500, and that's the best of all the metrics. You look at the Russell 2000, it's down huge. If you're down in the banking sector. Across the board, it's been carnage since the cycle peaked in November of 2021.
Okay. And I had to fact check myself there because you threw me off, and I found one stock, DoorDash. It's up 30% in last couple.
If he had Jay, if he had 100% of his portfolio in DoorDash.
Yeah. And I'm not saying that's what he had, but okay. So thank you for that context. So what are you paying attention to right now then, Michael, what's catching your eye that you think the public is misunderstanding in macro?
Well, I think they're listening to CNBS with the volume on. That's, I think, the first mistake is.
Okay.
You're hearing some of those guys that appear telling you that it's an all clear signal to buy stocks and the economy is going to boom now
Yeah.
just because the Fed stopped hiking rates. I mean, I'm looking at things like the labor market. So the labor market, in my opinion, is starting to crack. If you look
Okay.
at job cut layoff announcements, by the way, when I say things, I never just give my opinion on something without having it substantiated by some facts. So let's just look at this. So planned layoff announcements are up 198% from last year. That's a fact. Now let's just take a look at more evidence that the labor market is starting to crack, because people say, oh, the consumer's fully employed and he's getting raises, so the inflation is no longer a problem. We can get into that too. I think we have 40 minutes, so let's try to get below the sound bites that you hear on the mainstream financial media. So that there's two surveys when it comes to unemployment, the non-farm payroll report. There's the establishment survey and there's the household survey. Well, the establishment survey showed 150,000 net new jobs created, but what leads the establishment survey is something called the household survey. I'm sure you're aware of it. In that survey, there was 348,000 jobs lost in October, cut in October. And what I find most shocking is that, and people hardly ever talk about this, but there's something called the index of aggregate hours worked, which is just an index of the entire labor impulse into the economy. So, for instance, if one person has a job and they work 12 hours a day,
yeah,
and then that person gets fired and has to take two jobs that are 6 hours each, you have an increase of 100% in the number of jobs created.
Yeah.
But the impulse of labor hours, productivity in the economy is the same. And the income from the Walmart greeter and the Dunkin' Donuts guy who stands in line in the rain to take your order, that doesn't supplant the income he was making from, working in Wall Street or, some big bank. So, or in the manufacturing sector. So those are things you should understand, that the labor market, in the way I look at it, initial claims rising, household survey, layoff announcements, that tells me the beginnings of the labor market are starting to crack.
Yeah, that's an important metric, and one that actually David Rosenberg focuses on a lot whenever I have him on. It's not the jobs number, it's the work week. And he looks at the hourly work week, right? Because companies will.
You're a smart Canadian. You just interview people from the United States and they don't talk about the index of aggregate hours worked. But Rosie, one of the few people I respect on Wall Street, fellow Canadian, he nails it. Absolutely.
Very, very interesting. And I heard you on a recent audio file that you sent me talking about job cuts at Maersk. And I thought it was telling, because if you look at, a company like this, one of the world's largest shipping organizations, and I recall you mentioned they were planning something like 3,500 job cuts, it seems like a leading indicator, right? This is one of the backbone industries. And so if the company that's moving the things we need is looking at their near and midterm forecasts and saying, we're going to shed 3,500 people, it tells you a lot about the trickle down effects of that. So do I have those numbers right? And what does that marker tell you, Michael?
Well, it's not only that, I think you do have those numbers right, but it's not only that, but their revenue is down and earnings down like 94% year over year. Like, the earnings are just getting crushed at this bellwether company. It's one of the largest shipping companies on the planet. They're moving freight around the planet. And, to me, Jay, it's just emblematic of what's happening with the level of borrowing costs. So don't forget, back in March of 2022, borrowing costs were still zero. Now borrowing costs were 1% or less for 11 of the 14 years between 2008 and 2022. Now, just don't sit there and tell me, and I'm not talking to you, I'm talking about the mainstream financial media. Don't sit there and tell me that when you take borrowing costs to near zero for the first time in U.S. history, In fact, this was a global phenomenon. We're talking about in the airs too. Globally, there was $17 trillion of negative yielding debt. 17 at the peak, at the apex. So don't tell me there weren't any imbalances, economic imbalances created. Don't tell me that people didn't take out a lot of debt, governments included, corporates included, individuals, families included, when money was free for 11 out of 14 years. But now we see it starting to change. It's changed. We've gone from, as I said, minus 8% on a real Fed funds rate to a positive 2%. Not only that, not only do you have the monetary impulse that is gone, that QE phenomenon is gone into and morphed into QT. And we'll talk about this reverse repo facility in a second, because I just remembered I want to talk about that, about the chaos in the bond market. But you also have the fiscal side. If you notice what's going on in DC, there's not a lot of appetite for huge spending packages right now. It's dysfunction in DC. Not only that, but you see a lot of the stuff that we did, the crazy stuff we did, which is $6 trillion of fiscal stimulus, 4.5 of it monetized by the Federal Reserve. But now the COVID mortgage forbearance programs, like the FHA insured mortgages and reverse mortgages, that forbearance is going to end November 30th of this year. You got to pay your mortgage now. 17% of all mortgages are FHA insured. These people haven't had to pay a mortgage since early 2020. Jay, do you think that might perhaps affect consumption, which is 70% of GDP?
17%?
70%. Okay. Consumption is 70% of GDP.
Yeah.
17% of all mortgages are FHA insured right now, which is a lot higher than they used to be.
That's mind blowing.
2%. We don't have any 0% down loans. We've got 3% down loans.
Yeah.
Now, student loan payments sort of resume September 1st. I have my doubts about how many people are really paying, because you don't get you don't get dinged on your credit score like you should, but supposedly that's the case. But here's a big one, and Danielle DiMartino Booth is really in the vanguard on this front. The Employee Retention Credit Program, and this gave tax credits, so you're getting people money back, of $28,000 per employee. That is over. September 14th, the door closed on that. So you have 3 big fiscal stimuli that are now gone. And you're adding that to what's happening with banks. Now, if you look at the SLOOS survey, which is the Senior Loan Officers Opinion Survey, virtually across the board, businesses are not getting access to credit in the same degree they were in the Q3 as they were in Q2. So banks are tightening lending standards to corporations and individuals across the board. And the demand for that credit is attenuating as well. This is all a slow, Jay, this is why I have to talk some FOMO people. I have almost 900 accounts at Pento Portfolio Strategies, and a small percent of them, about 5% of them, they get nervous, like, oh my gosh, is the economy going to, they listen to CNBC and like, oh my God, the economy is going to boom, and the Powell stopped raising interest rates, and that means that the stock market is going to take off. I mean, nothing can be further from the truth. This is a slow moving train wreck, and I think the train wreck becomes a salient factor, completely manifest, as in recession in 2024, and I think the early part of 2024. And why do I obsess about a recession? Is I have a recession obsession? Is it a phobia of mine? No. Recessions are where you see the start of a recession, when the NBER declares that there's a recession that began, that the stock market usually plunges anywhere between 30 and 60%, 32 to 57 to be exact. That's the average, that's the spectrum of decline in recessions since the Great Depression. Now, I think Q2 GDP growth was like 4.9%. So we're not in a recession yet, technically. There's just no chance that's happening. So the earliest you can be in a recession, assuming Q3 and Q4 Q3 was 4.9%. So the soonest you can be in a recession is the end of Q1 2024. That's the earliest the NBER can declare a recession. And it's from that point that you see the decline in the major averages of between 32 and 57%. That's the band. So I don't want any part of that for myself or for my clients, and we're not going to be. In fact, we have a plan to protect and profit during this next recession. And then we can have all of that capital to deploy at much better, fairer asset price levels.
I'm Jay Martin. On November 30th, I'll be hosting an exclusive live online video event called Crisis and Chaos, The Changing World Order. I'll be joined by some of the world's top military experts, geopolitical analysts, and economic advisors. They'll be answering my questions and yours about the cascade of global crises since COVID-19. This event is for anyone trying to make sense of our crazy world. Find out what could be coming next and how you can prepare your mind, your money, and your family. Crisis and Chaos, The Changing World Order, an exclusive live online video event on November 30th. Click below to purchase your ticket now. Okay, so you're painting a pretty bleak picture. 3 major subsidy programs coming to an end or just recently came to an end. Lending for small businesses, medium-sized businesses as well, largely grinding to a halt. You touched on the real estate, the residential real estate market a little bit. I didn't realize the number of mortgage forgiveness was that high, 17%, and that's that program.
In FHA, not all mortgage. In FHA, there's a lot of people out there who haven't made a mortgage payment since 2020, since March of 2020. That's all coming due.
Similar scenario in Canada. People have been able to defer their payments and extend their amortization rates up to like 70, 80, and even 90-year terms temporarily. Now, Bank of Canada is now clamping down on this, and it's a very similar scenario unfolding up here. You touched on the bond market. So what do you want to focus on there? And what do you think about the traditional 60-40 portfolio today, Michael? What are your thoughts?
Well, before we go there, I want to just wrap a bow up on what you just mentioned.
Okay.
I didn't know about what you just said about the Bank of Canada, but unless they own, somebody owns all this debt, right, Jay? Banks are in big trouble. Banks, either the Central Bank of Canada or the Federal Reserve or just regular banks are in big trouble.
Yeah.
54% of all U.S. mortgages have a rate between 2.5% and 4%. Okay, that's the income. The bank's assets are the mortgages they hold.
Yeah,
now, the rate 2.5% to 4%, 54%. So that is well below their funding costs. So the T-bill is over 5% right now. So there's an inherent intrinsic run on the banking system right now, heading out of the deposits coming out of the banking system and running into treasuries. That's a huge problem for the banking system. Now, who owns all these mortgage-backed securities? Well, the financial industry does. And these assets are trading at 70 cents on the dollar. Jay, this is just a function of the rise in interest rates. This is not a function of a deteriorating economy. You haven't seen that yet. So remember, the mortgage-backed securities were the nucleus of the problem in the global financial crisis. It was twofold. It was not just rising interest rates that put these assets underwater. It was the fact that no one was paying their mortgage. They couldn't pay their mortgage. Well, 25% of homes are owned by investors. That's a record high. That is 1/4 of all homes, single-family homes in the United States, are owned by an investor. And when you rent that out, when your home is going up in value, the home price is going up in value, and you're raising rents because you can, and you have a renter who's paying you a very good cash flow,
yeah,
and your principal is going up, it sounds wonderful. It's a wonderful deal. I'm sure Blackstone was doing backflips not too long ago. But once home prices start to roll over a little bit, and you get renters who are no longer paying their mortgages because they're losing their job, then you'll see a flood of listings. Right now, people say, "Well, don't you know, there's a shortage of supply. We haven't." Blah, blah, blah. How could there be a shortage of supply if 1/4 of homes are held by investors?
Right.
It doesn't make any sense to me. And these investors, a lot of these investors own these homes at huge profits that they might want to cash out on while they still can.
Yep.
So I just want to tell you that I just want to wrap that up. The fact that banks are in big trouble, obviously, I guess in Canada, and it's clearly in the United States as well.
Now, okay, so I want to follow up on that. So they say, you know, there's no national housing market because it's typically housing performance is pretty geographically constrained or focused anyways. Where would you look, Michael, for extraordinary vulnerability in the housing market in the United States? Would you look at the markets that have been red hot for the last 2-3 years, like Austin, Texas, and Scottsdale, and, you know, these towns, or do any areas strike you as more vulnerable than others?
Well, according to the Case-Shiller Home Price Index, we have homes that have gone up 42% in the last 2 years. That's the average increase. Yep. So if you fall around that number, or you're on the other side of that scale where you're higher than the average, right, you got a long way to fall. Because don't forget, Jay, the home price affordability is the lowest it's ever been, because the home price to income ratio is the highest that it's ever been.
Yeah.
The only way you can reconcile that is you have a boom in earnings.
Something's got to correct. Yeah. Yeah.
And I don't see how you're going to have a boom in income that, that picture is going to be reconciled mostly. That ratio is going to reconcile mostly by having home prices fall.
Yeah.
And you mentioned the Sun Belt. I mean, unfortunately, I own a house in the Sun Belt, so okay. I've already lost 10% on the home that I purchased in July of 2022. Already down 10% comps from the comps that I see.
Okay.
Yeah. Not much talk about that, but that's in my neighborhood in Naples, Florida. That's what I see.
Yeah, I got it. I mean, we were looking in Phoenix 5 years ago, and ended up buying something up here instead. But as soon as I pulled the trigger on the house that I bought here, friends of mine started sending me listings from Phoenix showing me what I could have bought for the same dollar figure. And it was like, I'd be living like a friggin' chic, man. It was amazing. But, you look at those same houses today and they're up like 3 or 4 times, and they're just, that's a crazy market. What's your take on commercial real estate right now, Michael?
Well, I mean, it's the same horrible dynamics that are in effect for residential real estate are in place for commercial real estate, but you add into the fact of vacancies. Now you had this multi-billion-dollar WeWork company file for bankruptcy. I don't believe that those and they own. I think they owned like some 2 million square feet. I don't have the exact number, but it's not, maybe many more than 2 million, but it's a huge multi-million square foot number that they own worldwide. This is a worldwide company, but it's emblematic of the fact that the labor market is starting to crack. And I think the vacancy rate already is high and rising, and that's going to get much worse. That vacancy rate that's so high is emblematic of the interest rate dynamics we see already happening. It is not yet a factor of the labor market starting to shed jobs. When that happens, it's lights out. And I think you're going to see a lot of realization. I mean, the extend and pretend with these mark-to-market commercial mortgage-backed securities, that phenomenon is going to end. Once you start once you have to start marking the value of these assets down, it's going to be an echo of what happened in 2008.
Is this one different in the sense that the United States as a global empire is in a more vulnerable spot today? Like you look at, all these sort of local macro factors that we've discussed. You think about the $2 trillion debt, the $2 trillion deficit, the $32 trillion debt. And you look 34. At the global 34. Yeah. Globally rising competition externally. internal civil unrest that's getting kind of nuts and probably still heating up as we head towards the election. There's a lot of symptoms that, individuals would say these are the sunset years of an empire. This is what happens every single time. This is what happened in Portuguese Empire, Spanish Empire, Dutch, Britain, and now we're watching this play out in the United States. Do you find substance in that forecast, or do you think this is part of a normal washing out of a bull market process? And what's your take there, Michael?
That's not just my take. Just ask Moody's, who just lowered the credit rating of the United States, the outlook down to negative. Listen, the reason why they did that is because our deficits, as you said, they're already $2 trillion. And what happens when you have a recession? Deficits usually rise by 200%. So you could easily have a $6 trillion deficit as the revenue to the country evaporates, as it always does, and the automatic stabilizers kick in. I mean, what happens in an empire? All empires that have cratered before have many similarities, but the main similarity they have is that the middle class is eviscerated. So there's the elite, there's the oligarchs, they have the leaders in a nation, small top tier, and then you have a tremendous amount of people in poverty, and there's nothing in the middle. And when that middle class gets eviscerated, that's when you see revolutions. And I hope and pray that that's not the case. But the very entity that claims they care the most about the poor and the middle class is the one responsible for destroying it. And when you destroy the value, the purchasing power of money, an inexorable attack on its purchasing power, you destroy the living standards of the middle class. And that's exactly what's occurred today.
So talk to me about your portfolio right now. Where are you playing defense and where are you playing offense?
So as I mentioned at the top of the interview, I'm playing mostly defense right now. I have been doing so steadily since the end of 2021. What we have now is we have maintained a long position in US dollar, meaning that the US dollar is gaining ground, or at least it was, for the last 2 years against the euro and the yen. That's the dollar index, mostly the euro and the yen. That is not a comment to say that the US dollar is not getting decimated as measured against the other pairs, such as against gold or against real estate or against even cryptocurrencies, which I don't invest in, too, by the way. But yes, the US dollar is in trouble, but not against the horrific euro and the yen. So I have a position, a very good position in the US dollar. I'm looking to sell that as the economic data of the United States decelerates to match that of Europe and Japan, and that's going to happen in 2024. So I'm at the tail end of that trade. Okay. The other thing I have physical gold, which has done well for us. I also have a short in high yield. I have an anti-beta ETF that I use. I have been long aerospace and defense. That summarizes the portfolio as of this recording. What I plan to do is, I'm sorry. The largest part of the portfolio, by far, is short duration, short-term U.S. T-bills. By far, the largest part of the portfolio. So I'm spinning off a tremendous amount of income into the portfolio every month. What I plan to do, my next step, and I have a 20-point model that tells me when to do this, and thank God it's kept me from making some really critical errors, like getting net short in the portfolio too early. It's a critical mistake. You don't want to get net short the portfolio until the stock market's ready to crumble. You don't want to do it too late, but you don't want to do it too early either. So that's the essence and the robust quality of this model that I've created after 32 years in the business, going on 33 now. It's taken me decades to perfect this model. So I am waiting for the labor market weakness to intensify. I'm waiting for a certain trigger point in credit market spreads and I'm looking for financial conditions to tighten to a certain extent before I then enter into a net short position and climb on board the moniker I've given the four horsemen of the economic apocalypse, which I mentioned to you as cash, short-term treasuries, the dollar, and straight shorts into the portfolio. In other words, I will go long ETFs that go up in value when the market goes down. That's the strategy. That's where I am now. You mentioned the portfolio. I mentioned what the portfolio is now, but I'm letting you know where I'm heading at the appropriate time. I have fully intend to be riding the four horsemen sometime in early 2024. That first quarter is that's my target as of now.
Okay. What are your thoughts on the commodity sector?
Well, so there is no commodity sector in the mind of Pento portfolio strategies. There's precious metals and there's base metals and energy. So there's two different categories. I wouldn't conflate the two. So in a recession, depression, disinflation, deflationary environment, you would get out of base metals and energy. You'd be short those things. They always get destroyed. When the R squared, the correlation goes to 1 in that environment. However, gold is money. It's a currency, and it has a different volatility dynamics than, say, copper or oil.
Yep.
So I separate the two. I definitely want to own gold, and you can add on occasion silver and platinum in there too. But that has to be when the level of real interest rates is falling. So if nominal rates have topped out, and I think we're no longer in a sharp deflationary environment, that's the time you want to really lever up on gold. Take it all the way to 20% in the portfolio. I'm not there yet, but I plan on getting there. With the caveat, though, and I alluded to this. So if you look at the direction of real interest rates are rising in a deflationary collapse of the economy. And that's why you see at times you'll see gold is just used as a liquidity asset. So you just dump it because you have to wait. What do you need? Everybody needs one thing. They need dollars. They need cash.
Yeah.
And so they dump everything they can. So outside of that, once nominal rates top out, gold is an excellent investment. And so I'm looking to increase that until we reach that liquidity event. And then on the other side of that liquidity event, that's when I think that's when I think gold is going to be going to all-time record highs. Because what you'll see then is you'll see a never-ending regime of interest rate repression. In other words, the only way that the U.S. government can maintain any semblance of solvency is to have the central bank print money to buy bonds, just like the Bank of Japan is doing, to keep nominal rates from rising. And when you have nominal rates capped and inflation is rising, what happens to real interest rates? Well, they plunge, which is the absolute sweet spot for physical gold and even the miners at that point. So that's what I'm looking out for in 2024.
Okay. And in that scenario, I mean, 20%, but you also, would you look at like a GDXJ? Would you look at equities as well? How do you play that?
As I said, the miners, that's when the miners really come. Miners are just a leverage play on gold, much higher volatility dynamics than the actual, physical gold. So you got to be very careful, because there are times, and you'll see this happen before us, how I rigorously back tested my portfolio, and you just come up with some ideas of what to own. When the stock market goes down and is cratering as it evolves into a liquidity event, you'll see people, gold miners are stocks, and they get sold.
Everything, absolutely.
Everything gets flushed down the toilet, and they get hurt badly. Where physical gold will hold up much better in that environment.
Mm-hmm. Mm-hmm. Okay.
I want to say, before I don't want to forget this one thing. We have a massive valuation problem. I call it a triumvirate of bubbles. So you had the mother of all bubbles in bonds. You had and you have a massive equity market bubble, and you have a real estate bubble, all existing concurrently. That has never, Jay, that has never happened before. When in global financial crisis, you primarily had a housing market bubble. You didn't really have an equity market bubble. I mean, the total market cap of equities was 100% of GDP back in 2007.
Okay.
Today it's 160%.
Sure.
So you have a massive, in fact, that 160% total market cap of equity to GDP ratio is the highest ratio that ever existed prior to 2020. Think about that. I mean, it blows away where it was even in March of 2000. Like I mentioned, 17 trillion of negative yielding bonds in the world, and the most unaffordable housing market index we've ever seen. So all three bubbles exist together, and the S&P 500 is trading at 18.5 forward PE ratio. That assumes, if you listen to the Wall Street geniuses, that's assuming that we're going to have a 12% growth rate in earnings in 2024. Now, real GDP is supposed to be 2% growth in 2024. So I don't know. It's just there's going to be a shock in 2024. Now, it's already 18.5 times the 12% that's projected in 2024. We're already trading at that number. So we have a limited upside and a massive downside to equities, because there's no way with 2% real GDP, probably 4% nominal, somewhere around there. And you see that earnings tend to grow around nominal GDP. It isn't going to be 4%. It's not going to be 12% growth. It's going to be closer to 4%. And I don't even think it's going to be 4%, because if we have a recession, it's going to be minus 12%, not plus 12%. It could be even worse than that. So there's a valuation trap for those that believe that the Fed has solved the problem. Inflation has come down to 2%. It hasn't. It's going to stay at 2%. It will not. And that the economy is just galloping off to the races. It is a virtually 0% chance of that happening.
Okay. Look, Michael, I want to thank you for coming on today and walking me through your thesis and how you're parking capital accordingly. I like how the portfolio looks right now. You're sort of ready to be aggressive, right? Super heavyweight, short duration US T-bills coming to the end of your long US dollar trade. Physical, a lot of my audience holds physical, and I hold it as an option on liquidity, which is to say that if I have to option that, I do, right? That's what it's there for, right? It's the inconvenient savings. It takes a couple steps to liquidate, but it's, as a consequence, it's there. And long aerospace and defense, which is very interesting. And I'm not surprised by that, but
I'm not happy about it.
I get it. Yeah.
But listen, when you talk about liquidity, Jay, the liquidity in the treasury market, which is what I find most frightening here, because we just don't have the buyers any longer. We don't have Japan's interest. We don't have China's interest. We don't have the Fed's interest in buying. We don't have any real impetus from getting long a position in rapid disinflation or deflation. That's not out there in the market yet. You need that. You'll need that. Bid will come into duration treasuries, but it's going to come at the expense of stocks. I mean, people will be panicking out of stocks in preparation of the manifestation of the recession and hiding in long duration bonds. I plan on moving my T-bills out to the middle, the belly of the yield curve. But I'm not going to go out too far, because think about it. Who's going to buy? You think about, the trillions of dollars that's going to have to be pushed onto the stock market, to the bond market, investors on the other side of this next recession. And if I'm correct, and if the Fed has to buy this debt, and I think they will be, because otherwise you're going to have rates going well into double digits. What message do you think, Jay, that's going to send to the investors? Because you had 9% inflation in 2022. The Fed decided to fight the inflation by providing a real interest rate. In other words, a real Fed funds rate, 2% above inflation is where it is right now. That's going to fail and cause asset prices to crater. And if the Fed goes back into QE and ZERP, the Fed will at least tacitly, and I think they'll be screaming it, in no uncertain terms, that they can never adequately fight inflation without causing the economy to collapse, asset bubbles to crater. And that means that inflation isn't going to stop at 9%. Why would it? How could it? Because the only buyer we have for our treasuries is going to, in a normal economy, is going to be our central bank. Unless, of course, investors are buying treasuries because of the collapse of the economy. So it's the illiquidity in the treasury market, which we already see, and it's nothing yet because the reverse repo facility will probably hit zero. This is where the banks parked all their excess reserves. So as the Fed's doing QT, I mean, they're taking money out of the financial system, but they're adding it back in through the reverse repo system, as that's being used to buy treasuries. That runs dry in March, according to my calculations.
Okay. Then
even though it's illiquid right now, we'll just wait until March. And that's where you're going to see, like, yesterday, this interview is being recorded on Wednesday. So yesterday, you see interest rates plunge by 20 basis points in a day, and now that they go back up 15 basis points the next day. That's not the way the U.S. Treasury market is supposed to operate. It doesn't. It's, in other words, I think in March it's going to become dysfunctional and chaotic like we've never seen before. So watch out for that.
Okay. And anything, I mean, absent some kind of productivity boom, that would be it. I mean, on the back of, I don't know what, maybe some
AI. I know you go to AI.
Yeah, of course. Yeah.
Okay, I'll do my Dan. I can do my Dan Ives impersonation. AI. Well, anyway, listen, if you have a productivity boom that's led by AI, it's a possibility. I don't know. I'm not that smart to understand that yet. If it's going to be a productivity boom that occurs within 12 months.
Yeah.
But if it does, by definition, that means you're going to lay off millions of employees
because of the efficiencies of workflow.
Because of the efficiencies that come along with that productivity.
Yeah.
And that can't be good news for the economy or the stock market in the short term.
No, the middle class in general. Yeah. There'll be a few winners, many losers.
Yes.
Yeah.
Absolutely. At least in the short term, correct.
Yeah. Got it. Okay. Look, Michael, I want to thank you for coming on today. Where can people find more of you? If they want to find out more of what you're up to, your services, et cetera, where should we send them?
So it's pentoport.com is the website. On that website, you'll find the midweek reality check, which I produce every Wednesday. In fact, I have to hustle out of here soon and record it.
Yeah.
It just gives you the salient information that I've uncovered during the week that you should know as an investor. Unbiased. I'm not a perma bear. I'm not a perma bull. I just want to get it right. I want to get the direction of inflation and growth correct. So I unearth all of that arcane reality every Wednesday. And that is a $50 a year purchase if you'd like it. But there's a 5-week free trial. If you have $100,000 to invest and you're a U.S. citizen, I will directly manage your money under the rubric of Charles Schwab and Pento Portfolio Strategy. So contact me. It's 732-772-9500 is the office number, and my email address is mpento@pentoport.com.
Okay, awesome. And the weekly reality check is like a super simple 10-minute soundbite. Your download, what you've been paying attention to. Very convenient, highly consumable, and great, by the way. So $50 a year is a no-brainer. Yeah.
Thank you, Jay. I appreciate being on with you again.
Crisis and Chaos, the Changing World Order, an exclusive live online video event on November 30th. Click below to purchase your ticket now.